Hello and welcome. This is Owner's Equity, Bennett Tchaikovsky, CPA ESQ. Disclaimer, copyright. This presentation is copyright 2008 to 2018 by Bennett Tchaikovsky. The opinions in the presentation are that of the author alone and are not the opinions of the author's employers, including but not limited to Irvine Valley College, the South Orange County Community College District. The information contained herein or therein is not to mean to be any legal or accounting advice whatsoever. This presentation is going to kind of contain, or it will contain, a lot of my opinions about different things and how they should be accounted for. And so I will try to, the best I can, kind of differentiate that between how I view some of the accounting treatments and how some of them are just completely out to lunch. But those are important because as you are taking accounting, you need to understand what accounting's limitations are so that you can better advise your clients in terms of how to convey the various financial information. So let's talk a little bit first about corporations. And the most important thing to remember is that a corporation is really going to be a matter of state law. And the state law really will go through and dictate that. And to just kind of get an example, as far as how this works, if we were to go to the California Secretary of State website, which is sos.ca.gov, it's not the state of California sending out an emergency alert system, at least not yet. But if I come over here to business, and I look at businesses, I do business search with free images, and I look here, we're going to do a search here for Facebook. And when I click on Facebook right here, you'll notice here, Facebook Inc., it is a California corporation, but it says here the jurisdiction is Delaware. And that's very, very important. And because when it comes to corporate law, most corporations that are publicly traded will be based or have Delaware law essentially be prevailing. And the reason why is because Delaware law has been settled for many, many years. I will always make the joke in my classroom, if you ask 10 attorneys a Delaware law question, you're going to get one answer. If you ask them a question about California corporate law and how that's going to be interpreted, you're going to get at least 20, maybe 30 if you're going to pay a little bit more. So as you see here, Facebook, jurisdiction, Delaware, foreign stock. Again, Facebook, because it has its headquarters in California, is required to be registered as a California corporation. If an employee slips and falls at Facebook's facility, they're not going to sue Facebook in Delaware. They're going to sue Facebook in California, which is the appropriate venue. If a shareholder, though, brings a lawsuit against Facebook on a corporate law matter, then that is going to be litigated in Delaware, where Facebook resides. And you can also see this here on the corporation's SEC filings. I apologize for not having this up earlier. If you take a look at some of my other prior videos, I kind of go through in terms of how to look up companies, and we'll just do here for the Facebook. And we see their quarterly report that was just recently filed. And right here, you'll see that, oh, Delaware, state of other jurisdiction of incorporation or organization. So that's a really, really important part. So going back here to our corporation. So The greatest advantages in terms of being a corporation, of course, is the fact that you can operate as a separate and distinct entity from its owners. And I cannot emphasize this enough. Once you hire employees, you need to incorporate, or you need to go seek legal counsel. It's very, very important you do that. Partnerships can be somewhat kind of dangerous. And the reason is that one partner can be liable for the actions of another partner. Of course, they can go back and seek some kind of compensation from them. However, you have to be incredibly careful. So let's just kind of go through here and look at the corporate form of organization. And I apologize for this one. I'm like looking at this as, wow, this dude is crazy. Look at this thing. So anyways, when you have a corporate form of organization, it all starts with the shareholders. The shareholders are going to elect their representatives, which are going to be the board of directors. And this board of directors, their main duty is to hire really two positions, which is going to be the CEO and the CFO. And they're not going to really go through and employ or hire other individuals. The CEO and CFO then kind of run the corporation. They're reporting up here to the board of directors, which ultimately is going to be responsible to the shareholders. A few other things of note. If you've heard of something called like an internal audit department, generally it's corporate best practices is that internal audit department report directly to the board of directors. And the reason why that is because really as internal auditors, they're coming up with things that are really focused on how this entity here is functioning. So oftentimes you want that internal audit department to be separate from this, basically from the purview of these individuals here. You don't want them going rogue one, but you do want them to be kind of, at least reporting the board of directors and getting the proper direction. Over here for corporate governance, which I will do a separate presentation on, these here, this is really for the board of directors. A lot of times you hear the terms corporate governance. What does corporate governance mean? Well, what it really is referring to is that if you are a publicly traded company and you are listed on the NASDAQ or the New York Stock Exchange, or I believe it's the OTC, I think QX, which is their higher standard, you're required to have certain committees. You're required to have an audit committee, a compensation committee, and a nominating/corporate governance committee. These have to be staffed or have to have members who are independent. Very, very important, independent from the company. What does that mean? They can't have received more than a certain amount of compensation during any kind of year. They can't be the former CFO within a certain period of time or CEO within a certain period of time. They can't not have been a significant investor. So this plays a very important role because here the audit committee is really they're hiring and firing the auditors. You don't want the CFO to be going through and doing auditor shopping. You really want the audit committee to be carrying out that function. The audit committee is also overlooking the entire financial statement process. They're having closed door sessions if they need to with the auditors. They're also really making sure that the company is reporting the numbers properly. The compensation committee is going to be determining the compensation not only for the board, but also for the CEO and the CFO of the company. And then you have nominating corporate governance. The nominating committee is really going to be who's nominating other directors of the company. And you want this to be independent. And that's really, really important because you don't want insiders placing friends on the board of directors. Very, very important. One part of an audit committee is you have to have a designated financial expert. I've been one myself, and this is really going through and filling out forms. I am a designated financial expert, but that is self-certifying. I basically have to fill out an application. Excuse me. Wow, I've smoked 20 packs of cigarettes today. No, that's actually, I've been eating gobstoppers from my son's Halloween candies. The only thing I like out of those Halloween candies. So right here, you have the designated financial expert. This is going to be someone who's going to be self-certifying this. So I don't come out of the woods and say, oh yeah, I'm Tchaikovsky, I'm the bomb. No, I'm filling out a questionnaire. I'm listing out my experiences with preparing financial statements. And it's really up to the company to really make that judgment. The last one here is that I've kind of put in quotes right down here, special committees. Well, what does that mean? Does that mean the committee is special? No, what it means is that if you have a matter that happens that kind of falls outside of this and you want to independently investigate it, you generally will form a special committee. For example, Tesla. You can look at Tesla and see the amount of different things they've had going on. And generally, that's not going to be the audit, compensation, or nominating corporate governance, but that will be a special committee that's being formed by the board of directors. And one other kind of thing of note is that when you're, say, if I'm a single person corporation in California, you could have one shareholder, one board member, one CFO, one CEO, and you could be the only employee. This can be one person filling all these roles, or you can have multiple people doing it. It just depends on the situation. There is no right or wrong answer. So at some advantages of corporations, we kind of said here the separate legal entity. One of the advantages can be transferable ownership rights. And this really kind of applies to larger publicly traded companies, meaning that stock can be bought or sold, continuous life. You know, with Steve Jobs passing, sadly enough, is Apple still going on? Absolutely yes. The Walt Disney Company, is the Disney Company still happening? Absolutely yes. Ford Motor Company, well, we'll see, but Ford's still going for right now. And the other part of this too is that there's no partnership liability, meaning that as a partner, you don't have that partnership liability. The other advantage is here's the ease of capital accumulation. And I have to indulge myself right here because I want to look at my friends at Apple, who they're probably going to be shutting off all my devices at some point in time, but I just want to kind of show this to you here. So when we look at Apple, no, I just typed it in wrong. AAPL. When we look at Apple and on their quarterly report, Apple has approximately, in terms of their retained earnings, we want to talk about the ease of capital accumulation. Apple here has $79 billion of retained earnings, meaning that net income that it has accumulated over time that has not been distributed to shareholders. Does it have to be distributed to shareholders? No, it does not. But again, it's kind of something for your thoughts when you're falling asleep at night. And if you could just have one of those billions, you wouldn't be listening to this presentation right now. So let's go back here and go to here, disadvantages. With corporations, there can be double taxation, although with the new tax laws, that's kind of been changed to a certain extent. I'm not going to talk about that here today. And also here, governmental regulation is that corporations can tend to be more regulated by governmental authorities. Okay, so when an investor buys shares, and what's very important is that the rights of shareholders, it really depends on state law. California shareholders have a lot of rights. That's why most people incorporate in Delaware. So, and it's really, you know, when the investors buy stock, they acquire all the specific rights of the corporation charters, grants to the shareholders. And again, it's also here by the laws of the state, while basically where the company's operated in. Essentially here, you can have different types of stock, and one of those is common stock. But as a common shareholder, you generally have the right to vote at a shareholders meeting, sell or otherwise dispose of your stock. And note here, if this is a small private company, you're not going to have this ability. You only have the ability when you're buying or selling shares of a publicly traded company. If you were to have shares in Big Bennett's Barbecue, which does not exist, but if I sold you shares and there's no one else buying them, then you're really going to be somewhat illiquid. And that's why when you are investing in the companies of friends and everything else, you have to be extremely careful. So over here too, you can have preemptive rights. But again, this right over here depends on state law. And to receive receive the same dividend on each common share. Well, dividends are not mandatory. And then lastly is to share in any assets remaining after a liquidation. One of the things about common shareholders is you're pretty much the bottom of the food chain when it comes to when a company is going through a liquidation, say in bankruptcy. If I own shares of Sears, I'm going to be the last one paid out. The first one are going to be, well, the attorneys always win in bankruptcy. The attorneys generally win with everything, but they always win in bankruptcy. And so you're going to see those bankruptcy costs be paid out first. Then there's going to be some other types of creditors. And so really at the end of the day, once everything else has been paid out, the common shareholders will get something. So right over here. And then in terms of going to corporate governance, and we kind of talked about this a little bit earlier, but if I'm a general corporation in California, I'm filing my articles of incorporation with the California Secretary of State. I'm filing my statement of information, and I'm generally going to make my own bylaws. However, and that's what they really kind of call corporate governance, or like, what are the laws governing the corporation? And as the incorporator, those who are forming the corporations choose what the bylaws are going to be. And those generally need to at least consider the laws in that state. You can certainly modify them within reason, but again, it's going to have to be within the state purview. And again, this is my opinion. I'm not giving legal advice. Okay. So audit committee charter, compensation committee charter, nominating corporate governance committee charter. These are all optional. But if you ever wanted to go out and find one, is it easy to do? And the answer is yes. All publicly traded companies have to have these posted. So if you want to look incredibly intelligent, or just, you want to kind of have some fun, you can pull down the audit committee charter for Facebook. It's not very hard to do. I could pull down the bylaws for Snap. Not very hard to do. And just to kind of get something really clear in terms of the difference, is that there's a difference between like the nominating, the charters, and then things like company policies, like workplace discrimination, sexual harassment policies. These are generally going to be done here by management. Of course, we want the board of directors to make sure that they are aware of these, and the board should make sure that these policies are actually in place. You also want to have a code of ethics. That is incredibly important. And again, it's something that you're going to want to have everybody be signing off on. Okay, so I put here a, just so you can kind of see what it looks like. If we went to the NASDAQ website, which is miraculously pulling up here. So the NASDAQ is one of the stock exchanges, and they always want to help us in terms of going through and figuring out how to go through and list on their exchange. And one of the things that they have here, and you can see depending on their different, basically different markets, you'll see over here, oh, corporate governance requirements. And so right here, what are they required to do? Well, they got to file an interim and annual reports, and this is really filing their 10Ks and 10Qs on the SEC. They have to have independent directors, meaning that you have to have a majority of independent directors, and this is really for corporate oversight. Also, you have to have an audit committee, and this is what I was talking about before. One member of the audit committee must have the experience that results in the individual's financial sophistication. That's a financial expert. Compensation of executive officers. This is the compensation committee, nomination of directors, and then also over here, code of conduct applicable to all directors, officers, and employees. And this has become a very, very important part lately in terms of these codes being out there, and is everybody actually following them, like Wells Fargo. So over here, yeah, by the way, Wells Fargo, I'm not going to thank you for opening me up a second account, but I do want to thank you for giving me countless humor when I'm ever presenting bank reconciliations, but time to change the name. So over here, you have to have an annual meeting, and here you get conflict of interest policy and the like. And so all these different governance requirements is that if you want to be listed on the NASDAQ or on the NYSE, you have to meet a higher standard. Okay, it sounds like I always want to say those kosher commercials. We have a higher standard when it comes to our meat or to our hot dogs or whatever it might be, and that's really what it's referring to. You have to have a higher standard, okay, for if you are going to be a publicly traded company. Okay, so right over here, and just kind of talking a little bit about why Delaware, Nevada, and well, Florida, we don't really know what comes out of Florida, but we always want to be careful about that one. But why Delaware? Nevada, not just so much to an extent anymore, but I think most corporations are staying in Delaware. Nevada can certainly be cost friendly, but basically the laws are friendlier to corporations that are in Delaware. And there is also a significant amount of corporate case law. You can have real certainty in terms of what's going on. And just to kind of remember that some states, including California, have laws that are protecting minority-owned shareholders. And what does that mean? It does not mean ethnicity. It means that they own less than 50% of the company. And to remember these different terms, domestic corporation refers to the place where the corporation is actually domesticated. So Facebook is domesticated in Delaware. That's where its jurisdiction is. It is a foreign company, or it's a foreign stock company in California, right? So it's foreign in California. Now, what exactly is Alien? Is that Alien versus Predator? Is that the Alien Resurrection? Is that Alien 3? Is that Aliens? Is that Alien, I don't know, what is it, Prometheus? And then can't remember the next one. I mean, I don't know, I like the earlier ones. The first Alien's pretty solid. Aliens is good, but I don't know. So an alien corporation refers to a foreign corporation that's operating within the United States. So if it was, I want to say, but if there's a foreign corporation that's operating in the United States, that is what would be an alien corporation. Okay, some other special considerations for corporations are buy-sell agreements. If you are doing business with anybody, and it doesn't matter if you know them forever, if you've known them for 20 years, you need to have a buy-sell agreement. The reason is once you issue shares to somebody, they can get up and walk away. You need to have a buy-sell agreement. Watch The Social Network. If Mr. Zuckerberg had hired an attorney and not used someone in-house from Harvard, probably could have saved himself a lot of money. But in any event, but we wouldn't get the entertainment out of it, and I couldn't talk about it here. So you want to really buy-sell agreements. If you're starting up a company, you have to get these done. I cannot emphasize this enough, and it's really to control the ownership. You also want to use them for if you're going into business with somebody and there's an expectation that they're going to be doing a certain amount of the work, you want to get that in writing. It's incredibly important. Also, too, if someone's married, there's a divorce, that is an absolute mess. The only person who wins in divorce are the attorneys. And if there's a divorce and someone's holding shares, it can be an absolute nightmare. And as I mentioned before, you can have one person who's serving as a shareholder, director, officer, and employee. Also for corporations, if you think about it, would you be loaning money to an individual or a corporation? If I'm a small mom and pop and operating as doing business as filing a Schedule C, it's going to be harder for me to get financing because that is not an entity that is distinct from myself. Whereas if I have my own corporation and that corporation is operating separately from me, that can actually be something where you're looking at that and somebody's going to give you financing potentially. And again, there is also a cost benefit to corporations. The biggest thing is that if you are going to be hiring employees, you want to incorporate. We're going to do an LLC, go talk to an attorney, but you want to incorporate. I can't emphasize this enough. And it's really because of the personal liability that you have once you start having employees. So I'm going to cut the presentation right here and we'll start up with Common Stock Part 2. And we'll do that in just a few moments. But thank you for watching today. Please like and subscribe. And I will see you on the next video. Thank you.